I would like to thank our sponsor of today's episode, Miller Cooper. Founded in 1919, Miller Cooper is the 11th largest accounting and consulting firm in the Chicago area. They have 335 professional staff serving middle market businesses and their owners. On a personal note, I've had the opportunity to do several transactions with the folks at Miller Cooper, and in particular, Tad Render, who leads the firm's transaction advisory services group. And they are top notch. In every transaction, they really pull their weight in more than one way, and our clients couldn't have been more satisfied with the work they did. So I appreciate them sponsoring this episode, and if you have the need at any time for M&A accounting and advisory services, I really highly recommend the folks at Miller Cooper. Hope you enjoyed today's episode.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Domenic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Domenic Rinaldi.
Hello, M&A Unplugged community, and welcome to today's episode. I'm going to take some time today to talk about the three foundational components that go into an owner of a business really being ready to sell their business. And before I do that, would like to reference one of the first episodes of 2020, Dr. Bart Basie. If you haven't had a chance to listen to that episode, please go back and take a listen for both buyers and sellers. And if you're an accountant or an attorney, you haven't listened to that, Dr. Basie, who's an expert at all tax matters related to M&A transactions, really gave some tremendous information, lots of examples of where he has been able to save people hundreds of thousands of dollars, and in many cases, millions of dollars on their transactions just through really understanding tax code and how to properly set up either an acquisition or a sale of a business. And I referenced in that interview a deal that he was involved in with us where we had a C corporation as a sell-side client, and we had looked at the tax ramifications of that deal with the client's accountant, and the tax rate that came back was somewhere in the 54% range. And we thought that there was another way to really structure that deal. We contacted Dr. Basie. He came in and looked at that transaction, and we got the effective rate down to the low 20s. It saved our client hundreds and almost $1 million in taxes. A credible outcome for our client. So great episode, and I highly recommend talking to Dr. Basie if you're thinking about buying or selling, just about, structuring the proper deal. So wanted to launch into today the three main components that owners of businesses should be considering well in advance of a sale of a business, because some of these pieces are going to take some time to really pull together. And when clients come to us and our firm, Sun Acquisitions, we always start with these three components. And if it looks like the client has a good handle on these three components, then it's probably high likelihood that that business is going to have a successful transaction. If one of the three is not in good shape, really lowers the odds of having a successful transaction and may even lower the odds of that business selling at all. And so these are really important components to pay attention to, and things you can do well in advance, even if you're not ready to sell your business, things that you can be doing so that you're maximizing the value of your business. And I always like to say that you have a plan in place. Maybe you're looking to sell 10 or 20 or 30 years from now, but life happens. Some event might force you to have to look at a succession plan or an exit. Why not run your business every day as though you might have to turn it over? So with that said, let me get into the first component. And the first component is related to the owner's personal financial situation. And so as it relates to that, what's most important is understanding what your number is. What do I mean by your number? What number do you need in order to walk away from your business to maintain your lifestyle at whatever level you need it to be maintained at? And for some people, after they sell a business, their lifestyle is going to go down a bit, so their monthly burn rate comes down. For others, might stay the same or maybe even go up because they're going to travel more, or maybe they're rolling the proceeds into another business and it's going to require some good capital. So understanding what your number is critical, because you then have the benchmark to work against to decide whether or not your business is there. And if not, when we get to the second leg, we'll talk about what we do there. But in addition to understanding what your number is, it's equally important to have all of your estate plan and tax considerations worked out. So in the case of an exit, what would happen with your business? How's your business held? Is it held in a trust? And what are the tax implications of potential transfer? How much of that sale are you going to keep in your pocket? Which is critically important, because sometimes your number can be lower if you can obviously maximize your tax situation. And so many professionals here to be talking to, right? So highly advise working with a wealth manager or a financial planner to help you understand what number it might be that you need from your business in order to walk away. Plenty of models that they can run for you in different scenarios. You can run conservative scenarios or aggressive scenarios, but running these scenarios really helps you understand what that number looks like, and benchmarking whether or not your business is even close to that. The next set of professionals that really matter are estate trust planning attorneys, making sure that you look at how your business is held, what would happen upon a transfer, and whether or not you've got the most advantageous tax situation. And an estate tax attorney is going to help you work through all of those issues. And we've had different attorneys on our podcast that you can refer to who can help you think through that and make sure that you've got all those pieces set. Because if you can't have this piece done, if your personal financial situation can't be secured, you got a lot of work to do in number 2, which is your business readiness. And business readiness is a big, meaty topic. So I like to talk a lot about the value drivers of a business. And there are many value drivers, probably 8 to 12 value drivers, depending on the business. And where is your business in relation to all of those key value drivers? And let me go through a few of these so you understand what we're talking about. So the first one is the financial performance of the business. What has been the historical financial performance of the business? Is it steady? Is it slowly growing? Have you had peaks and valleys? Is it up and down? How has the business performed? Obviously, the more steady the business is, the higher the value of the business. And so it's really important to understand where the business is and how the business performs on key metrics and key ratios as it relates to industry standards. And so I'm going to pick an industry. If you're in the HVAC industry, heating, ventilation, and air conditioning, there are benchmarks for what your cost of sales should be, your labor expenses. Do you understand what those benchmarks are? How does your business compare to those benchmarks? And there's a lot of industry reports out there that can give you this information. If you can't get access to that, you could always call us at Sun Acquisitions. We have access to industry reports and benchmarks, and we can help you think through that through an analysis. The next piece of the puzzle is, what are the growth prospects for your business? One, the industry that you're in. How solid is the industry? What are the future prospects for that industry? But then two, if a new owner were to take over, what would they do with your business? Where would they take it? How would they grow it? What are you doing to execute against those growth plans? And how easy are those growth plans to execute? Does it take a big investment, small investment? And this is important, especially if you're going to transfer the business to a new owner. It's one of the key things that a new owner wants to understand is, where is the growth in this business going to come from? Because nobody wants to buy the business and have it run the same way, static. Everybody wants to come in and take the business to a new level. So very important that you understand where those push and pull points are, and that you can communicate that to a new prospective owner. One of the next important pillars, value driver, is concentrations. The first concentration that we focus on is client concentrations. So do you have any one client that represents more than 20% of your business? If so, that is a potential jeopardy for a new owner. And it's a jeopardy for you. So even if you're not looking to sell, there's some jeopardy that if you lose that top client, that your business can become immediately unprofitable. And you should be doing everything to minimize those concentrations. And if your top 3 clients are 50% or more of your business, same thing holds true. You should be doing everything you possibly can to minimize those concentrations. Critically important. But there are other concentrations, vendor concentrations. So does one vendor represent the lion's share of the products that you're selling? Or 2 or 3 vendors represent the lion's share of products? Again, you want as much diversity in your business as possible. The more diversity you have, the higher the value, the less risk there is in your business. And this is all about risk and reward. The less risk in your business, the higher the value of your business. The other concentrations are related to employees. So do you have 1 or 2 or 3 employees that are so critical to your operation that if they left, it would create a meaningful void in your business? Again, if so, just like clients and vendors, you should be doing everything possible to mitigate that key employee concentration. Cross-training people, hiring up, doing what you have to create a support team around that key employee. So if they were to leave, people can easily take over those functions. As soon as 1 or 2 or 3 employees become so critical to your operation, the risk for you as an owner goes way up. The risk for a potential new owner or acquirer obviously goes way up. The next category is related to sales and marketing. We'll tell you, in all of my years of M&A transactions, this is typically one of the areas that most owners pay little attention to. Really building a solid sales and marketing function. Many cases, owners become, the pseudo Salesforce or the lead salesperson, and there's risk in that. Because a new owner that takes over is going to worry that you have most of the relationships, and that creates risk for them. So creating a solid marketing plan where the business generates leads through processes, whatever they are, whether that's social media marketing or an inside sales function that does telemarketing phone calls, however it is that you generate leads, going to trade shows, but that you have a clear marketing plan that is in charge of making sure that your brand is protected, that you've got goodwill in the community, and that the marketing function is generating leads for your sales organization. And then that you have a really good sales organization, and not just one salesperson, but hopefully a couple that know how to close business and are incented properly to stay with the business and help you grow the business. Can't stress enough how important sales and marketing is to a new owner coming in. And for you as an existing owner, again, if you don't want to sell for 20 years from now, how much stress that takes off of your plate if you've got this function well thought out. In line with sales and marketing is recurring revenue. If you can build recurring revenue into your business, you have now increased the value of your business dramatically. If business is going to come in monthly, and I'm not talking about repeat business here, there's a real difference between repeat business and recurring revenues. I'm going to use the HVAC industry again. They've done a really good job over the last 10 years, as I can tell, in building in service contracts to their businesses where they have clients sign up for annual renewable contracts and they auto renew, and that automatically gives someone 1 or 2 or 3 visits a year. And that's just going to happen like clockwork. And every year auto renews, there's a bill that goes out, and that is a good example of recurring revenue model. Even better if you can build something that is recurring revenue on a monthly basis where you build a subscription model into your business. But anything you can do, even if it's a small percentage of your overall revenue, to build some base of recurring revenue increases the value of your business dramatically. Repeat business, clearly not bad. I mean, we all love repeat business, but recurring revenue is in a league of its own. The next value driver, the next thing that people look at is what are the capital requirements to run that business? So very simply stated, how much capital needs to be invested in that business month in and month out to generate revenues? And obviously, the less capital you have to spend every month to generate revenues, the higher the value of your business. So you're running a manufacturing plant and you're constantly having to invest in new technology, new machinery, that increases your capital requirements, which increases the risk of your business, because if there's a downturn, is that new piece of machinery going to be able to support the debt service that you've taken on to bring that new piece of machinery online in the business? The less capital that you have to put into the business, the more cash flow that you have in the business, and the higher the value. Competition is the next value driver to take a look at. So how much competition are you up against? How easy is it for competitors to enter your market and start competing with you? Are the barriers to entry high? Are they low? In this regard, do you have a niche that's going to be hard for somebody to replicate? Easier it is for a competitor to come in and compete against you, the lower the value for your business. And if you're in that situation, you should be thinking about, can you create a niche? Can you carve out something in your business that gives you a competitive, sustainable advantage? And if not, should you be looking at adding, completely different product or service line that gives you that advantage? So competition and understanding where you fit in the competitive landscape really matters. Customer satisfaction is very high on the value driver list. How satisfied are your clients with you? Some of the things that people use as benchmarks are there Google reviews on your business, or some sort of reviews that people can easily see, and how do you fare in those reviews? If you run the type of business that doesn't lend itself to Google reviews or Yelp, and by the way, if there's anything you can do to get your business Google reviews or other types of reviews, very important, especially as it relates to social media and search rankings, really helps quite a bit when you can get great social media reviews on the internet. But if your business doesn't lend itself to those sorts of reviews, there's other ways to go figure out if your customers are satisfied, and some very easy ways. The one that I refer to more often than not is something called the Net Promoter Score, NPS. You can look it up. It's a very simple way. It's one question that you ask your clients, and you can relate their responses, and it allows you to mathematically come up with where you sit as far as a net promoter score, and a great way to really understand what your clients think about you and your firm. Again, you can easily look it up on the internet, net promoter score, great way to evaluate your business. The next value driver and the last value driver that I'm going to talk about in this section of, business readiness is whether or not your business is a self-managing business. It simply comes down to how much are you involved in the business as the owner. If you are highly involved in the business, the value of your business is going to be on the lower end. The more and more you can turn over to people in your business, the more responsibilities that you can turn over, so that you're spending more and more of your time on strategy and high-level stuff that isn't related to day-to-day operations, you have increased the value of your business dramatically. Probably also increased your level of satisfaction, because now you are not the person that has to be involved in every aspect of the business, or in key aspects. You've got the proper processes in place, the proper people in place, checks and balances, clearly very important. You want the right checks and balances so you know the business is operating properly. But the more you can do that, the higher the value of your business. And then the last thing that's not related to value driver, but the thing that you need to understand is, what is the value of your business, right? So getting a snapshot value of your business every couple of years should be high on your list. There are statistics out there that 90% of an owner's wealth in most cases is tied up in their business. So put another way, an owner's business is typically, if not their largest investment, in their top three. And so understanding the value of your business and how value drivers impact that value up or down, and where that value sits every couple of years, is critically important. And obviously that feeds into the first part, which is your personal financial readiness. You're going to need that number in order to be able to talk to your financial advisor about what your business is worth, so they can plug that into whether or not you are ready from a personal perspective. Okay, so that leads me to item number 3, which is a really important topic. And maybe if you are at the point where you're considering a sale in the next year or two, this becomes critically important, maybe the most important, which is your emotional readiness. Are you emotionally ready to walk away from the business? And this really requires some soul searching, asking some tough questions of yourself, and really being honest in those answers. When we meet clients for the first time and we do an intake with them, one of the key questions I'm going to ask is, what would you do after the sale of the business? And when owners respond in a vague way, or they're not really certain what they're going to do after the sale of the business, that really worries me. I'm concerned, because that tells me that maybe they haven't gotten to the point where they can disconnect from the business. And this is problematic, because if you can't disconnect from the business, but you go forward with a potential sale, you're going to get through that process halfway through, a quarter of the way through, maybe even right up to the day of closing. And you're going to feel tremendous remorse. You're going to have a lot of anxiety. You may even wind up pulling out of the deal, and you would have spent a lot of money and a lot of time when you weren't really ready. So understanding your readiness matters. The answers that I love to get to the question that I ask clients the first time we meet them is, when they can describe to us a post-sale scenario. I use this example often, but an owner who said to me once, "Look, I've got a place in Colorado. I can't wait to get there. I can't wait to have my grandkids come and visit. Can't wait to teach them how to horseback ride and fit." That owner clearly envisioning the next stage of their life and what they're going to do next. And that's great because it tells me they're going to be ready for the ups and downs of a process. They're going to be realistic. And assuming that we can get decent offers, they're prepared to move on and they've reconciled that for themselves. Critically important. I have a dear friend who went through this process recently, sold his business. He's on the younger side, and he was very happy, completely happy with the financial outcome of the transaction. No issues there. But 6 months removed from the transaction, he woke up and he realized he really didn't have the next plan for his life. And he's really sort of struggling with what next. And he's having to figure that out. And it always helps when you've got plenty of money in the bank and you have time to go figure it out. But it's an issue nonetheless. And it can wreak havoc on your psyche. And I heard a statistic last year at a conference that 70+% of owners have some remorse about selling. And it has nothing to do with the financial outcome. It has more to do with they didn't know what they were going to do next. And it's created some real angst for them in their life, in their relationships, and trying to figure out where to go. In all of this, so those are the three legs of the stool. Are you personally ready? Is your business ready? And then are you emotionally ready? And regardless if you're looking to sell today, you should at least do step number 1 and step number 2 all the time so that you constantly know where you are on that spectrum of being ready if a life event happens and you have to sell very quickly. And then you can always do the third leg of the stool, emotional readiness, as you're getting closer to really thinking about exiting the business. In all of this, my high-level advice is surround yourself with the right advisory team. Get a good wealth manager, get a good estate and tax attorney, get a great accountant who really understands tax law, get a good M&A advisor, get a good business consultant or coach. The right team can really help you build a business that's got maximum value, that is ready at a moment's notice if you need it to be. And if it's not, you're running at maximum value. So you're happy, you're less stressed, and it just makes for a better situation. I hope you enjoyed today's episode. I hope this information was helpful for you. I'm really excited about some of the upcoming interviews that we've got coming with folks around some of these topics. In fact, I think sometime in February or early March, we've got an episode coming from a gentleman who has built a self-managing business. And his story is a great one. And he's in a business that you would never think could really be self-managing or could be built into what he's done with it. Tremendous story. And we've got some additional guests coming on board that would some great topics. So I'm really excited about how 2020 is unfolding. And I hope you found this information useful today. All of this information will be available in the show notes. If you need to reach me or contact us about more information, you can get me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.